So in a move to support oil prices, OPEC Plus countries, including Russia, have agreed to extend most of their significant production cuts through 2025. This decision comes amid concerns about slowing global economic growth and rising interest rates. Now, the deal extends deeper cuts of 3.66 million barrels per day for a year and maintains some voluntary cuts by 8 members for an additional 3 months. However, OPEC Plus plans to gradually phase out these voluntary cuts over the following year. Meanwhile, Nigeria's oil production is set for a potential boost in ExxonMobil as it awaits the lifting of an injunction preventing the sale of its asset to Seplat Energy. So this morning from Abuja, Nigeria's capital, I have joining me Kelvin Emmanuel, Economist and CEO at Dairy Hills. Thank you so much, Kelvin Emmanuel, for joining us.
Thank you. Good morning. Thanks for having me.
Of course, it's nice to have you around. Let's quickly look at the issues now. High interest rates is highlighted as a concern for OPEC Plus. Could you, brother, look at the economic factors and help us understand this in the light of the potential global recession and the influence oil demand and OPEC Plus strategy would have in all of this conversation?
Look, I've not been a fan of Nigeria staying in OPEC. In fact, I mentioned my opposition to it for quite a bit now. Last December, when Angola decided to leave OPEC, I mentioned that the strategy Nigeria has going forward, which is to pivot some of its production in terms of the share of production sharing contracts the NNPCL gets from its joint ventures, POAs and JSCs, coming down to the midstream in Nigeria instead of exporting out of Nigeria. Along with the domestic crude oil supply obligations, changes that OPEC dynamic that Nigeria has always had for many years since it joined, I think in the 70s, So, OPEC saying that high interest rate, the macroeconomic picture in Nigeria, and for lack of forward guidance, the fact that you still have lack of forward curve for the exchange rates, you see dilly-dallying, and companies are not able to plan because as much as I think that the exchange rate is going to settle at around 1,200 and 1,250 within the next 6 months, it's very difficult for companies to be able to plan their investment decisions. I really consider the lack of macro clarity in Nigeria as a stumbling block and a problem for the economy, and as an impediment to attracting investments into Nigeria. You could see the chairman of Total Energies mentioned one of the reasons why they decided to divest away from Nigeria was because in 2022, the Nigerian government decided to add a 30% tax on gas, and that affected the outlook for investments in upstream production and the associated gas that comes from upstream production. So I honestly believe that starting off, the way to go is for the Nigerian government to actually pay attention to its Petroleum Industry Act, PIA of 2021, that was signed in August of 2021, and to provide the international oil companies and national oil companies with clarity on taxes, on dividend structure, especially when you consider the owner of block, the government's own enterprise, and the operator of the block dynamics, and you consider the new production cost per barrel and all the security issues we have in Nigeria. So for me, I think that the government needs to think, and needs to be proactive, needs to think about the future of the country, especially its midstream sector, investments in the midstream sector, and how it needs to divest away from the OPEC strategies had to supplying the domestic refineries, especially commercial refiners in Nigeria, with the crude oil that it needs, away from the normal trend of exporting crude oil to OPEC members and off-takers.
Okay, well, you've spoken expressly as to how it affects or applies to Nigeria, but then let's look at look at it from a broader spectrum. Now, OPEC Plus has actually faced challenges with member states adhering to production quotas in the past. Now, a new directive has been given by OPEC rather. How do you think OPEC Plus would ensure stricter compliance with the extended cuts, especially considering the year-long time frame?
Well, stricter compliance with production cuts, it's an issue because OPEC is always trying to manage price, to ensure that, when you look at the unit production cost per barrel and you look at how much OPEC members are getting from international off-takers, it's always in a stable range. It's always wanting to maintain that $75 to $85 per barrel level. And then the countries who offtake from OPEC are always wanting to ensure that crude oil price doesn't exceed $90 and $100 per barrel. So it's always like a fight between, the declaration of an agreement between OPEC and non-OPEC members, the countries that produce crude oil but are not in OPEC, ensuring that there is a specific level of cuts to ensure that price doesn't slump and there is not a supply glut in the market, because the global market produces about 88 million barrels per day. Nigeria, OPEC, the entire OPEC does about 31 million barrels per day. So you could see that, OPEC has only somewhere around maybe 29 to 30% of that entire mix, and is always trying to ensure that the level of production does not lead to a supply glut in the market. But then it comes to Nigeria, and it comes to the fact that OPEC has pegged Nigeria's output to 1.5 million barrels per day until 2026. And this is the reason why I don't agree with Nigeria staying in OPEC continuously, because if you peg the output at 1.5 million barrels per day, considering Nigeria was doing between 2.2 and 2.5 million barrels per day a decade ago, and Nigeria has issues with being able to stabilize its FX market from the dollars that comes from exporting crude oil. You see that it's not a sustainable strategy to stay within the OPEC framework.
Well, you've talked about price, you've talked about the level of production and what is sellable. Now, beyond the immediate production increase for Nigeria, how do you think, or how will Seplat-ExxonMobil deal impact Nigeria's long-term oil revenue sharing agreements and, of course, the potential reinvestments in that sector?
Well, the Seplat deal, it simply talks about preemption rights, the transfer restriction rights. So basically in joint venture agreements, there's a right of first refusal to joint venture partners. It's just like a company that is publicly quoted going to the stock market. It's already done the IPO. It's going to another round of capital raise. There is the right of first refusal the company has to give to existing shareholders to buy the shares. The preemption rights here between NNPC and Mobil simply says that Mobil had the obligation to offer NNPCL the shares it wants to sell, especially for its onshore operations, before it actually offers to a third party, which is Seplat. And it's my understanding that maybe that was not done, but that was done and the terms were not concluded between Mobil and NNPCL. Mobil was the operator of the block, and NNPCL is the joint venture partner. And so he decided to offer to an external party who was willing to pay more than what the JV partner was willing to pay. So basically, the JV partner decided to go to court to trigger the preemption rights to prevent the operator of the block selling to a third party without fulfilling the obligations of right of first refusal to NNPCL. But considering that single decision, and the fact that the government stalled that deal from going through, led to a drop in production output of nearly 500,000 barrels per day, says so much about what that deal going through now will do to increasing the production output on a daily basis.
All right, I know that you've actually grazed it, but I'd like you to speak more elaborately on the specific legal details surrounding NNPC's preemption rights on the ExxonMobil assets and how the settlement agreement addresses them.
Well, I don't think I will be able to speak in specific details, like, specific, broadly clear the details.
Yeah, of course.
It's basically preemption rights is a right of first refusal. In JV contracts, the operator of the block, because you usually have like 30 parties in the JV contract, the operator of the block, the owner of the block. Sometimes the operator of the block is the same with the owner of the block. Sometimes the JV partner on the government side is also the owner of the block, you know. So you had a situation, and this is what you've noticed with IOCs. IOCs are divesting away from onshore fields and shallow waters because the crude oil theft and insecurity in the Niger Delta, especially onshore, has impacted on their costs, unit production cost per barrel. Even if I think unit production cost per barrel at $48 to $60 per barrel as the highest in the world doesn't make any material sense whatsoever. And the companies and the government cannot give an excuse of insecurity as the reason why you have the highest unit production cost per barrel in the world. You also have to consider the fact that there is hydrocarbon remediation program that companies have had to invest in. There is a security trust fund that the companies have had to invest in. There are all kinds of legal cases within and outside Nigeria that the companies are backed with. So, and that has impacted on their decision to divest from their onshore and shallow water operations offshore. And the fact that they're selling their onshore asset means that if they don't offer preemption right of first refusal to their JV partner, which is NNPCL in this case, then they have to come to an out-of-court settlement or alternative distribution so that this doesn't drag out and stall production for Nigeria.
All right, noted. Kelvin Emmanuel, Economist and CEO at Dairy Hills, thank you so much for talking to us.
Thanks for having me.